Vejo um polegar positivo, estamos no ar. Que comece o episódio 50, eu vou repetir, episódio 50 do Clube da Exame Invest, começando neste momento. Bruno Lima, visivelmente emocionado, venha para a mesa central celebrar o episódio 50.
Tô honrado. I'm honored to be here. Porque today
Por que o inglês, Bruno Lima? Explica pra mim o porquê o inglês.
Today's gonna be in English, my friend. Hoje vai ser em inglês, não é isso?
Perfeitamente. Para comemorar, celebrar o episódio 50 do Clube da Exame Invest, tivemos a honra de trazer aqui na mesa central o fundador e CEO da Gavekal, uma das casas mais respeitadas e admiradas dos investidores globais, para nos guiar o que esperar nesse mundo, nesse contexto global cada vez mais complexo. So let me switch to English with no further ado. Louis-Vincent Gave, welcome to Clube Exame Invest, and thank you very much to be here, sir.
Thank you so much. Look, I actually understood a lot of what you said. That was very flattering. So thank you. And I'm also extremely flattered to be here for the 50th. So thanks for having me, guys.
No,
it's
for
a real
us,
pleasure to be here.
it's really an honor to squeeze us in your busy agenda here in Brazil. It's been a long time that you don't come to Brazil, I suppose, at least pre-COVID, right?
That's right. I think last time I was here was 2019.
We are looking forward to hear your view in Brazil and to hear your pick in Brazil, especially because of this question. Yeah. Bruno Lima can confirm. All the big economists and portfolio managers that we host here, there's a growing consensus like this. Okay, Brazil is becoming the cleanest dirty shirt among the emerging markets. So beware to be short Brazil. Beware to, be selling Brazilian assets because it could turn out to be the cleanest dirty shirt among the emerging markets. I'll get your view if you agree with that or no, and if you're a buyer of emerging markets or Brazilian assets or no. So let's save this for the end. First things first, our icebreaker. To break the ice, Louis, what do you do in your spare time in terms of sport and activity?
You mean apart from participating in podcasts?
Yeah, sure.
So I'm originally French, and in France, there's two big sports. You have soccer, and you have rugby. And the one you play depends a lot on where you come from. If you come from the Southwest, basically west of the Rhone River and south of the Loire River, you play rugby. And if you come from the north or the east, you play soccer. So I come from the Southwest. I'm a rugby player. I still play today. In fact, I buggered my shoulder about a month ago playing back in Hong Kong with my club Valley. And I actually own a professional team in France. As soon as I could afford one, I bought one.
So we can hire Daniel.
There you go.
Is it possible to hire like a 5'7" guy to play rugby?
We actually have a couple 5'7" guys.
Bruno Lima for sure he could play rugby, but I don't know.
But this is why rugby is a great sport. It's actually a team where you need all shapes and sizes. You need short, fat guys. You need tall, thin guys.
Yeah, I could fit in.
You need short, thin guys who run fast.
Short guys.
Yeah, you need all sorts.
Extra short. Like
you can with your body type, you can play as long as you have a terrible attitude and you're able to run your mouth. And from what I saw in the first segment, you are able to run your mouth. Then great. You could definitely be a scrum half.
I'll send my application. What is the name of the team?
Biarritz Olympique. So it's the team in the Basque country. So we're basically really close to the Spanish border on the Atlantic Ocean. When people know Biarritz, they know it either for the rugby or for surfing because it's Europe's surf capital.
That's great. So let's register rugby as your spare time activity. That was great to hear. Louis, actually the following question we usually ask the guests to say, hey, how you ended up working in the financial markets. But in your case, and as you have, and we really like to cut to the chase to have your views on global China, US, and all this, not much trivial period that the global outlook is navigating right now. Let me just, but I want to address your amazing background because it's just amazing so people can catch up. So Louis Gave, after receiving his bachelor's degree from Duke University and studying Mandarin at Nanjing University, Louis joined the French Army, where he served as a second lieutenant in Mountain Infantry Battalion. you served the army. What a great background. A couple of years later, he left the army and joined Paribas as a financial analyst. In 1999, you launched Gavekal with your dad, Charles Gave.
That's right.
And Anatole Kaleski, a huge fan. So the idea at the time was to cover Asia, from Asia, and boots in the ground from Asia. That's great. You just have written 7 books. That's it. The latest, Avoiding the Punch, was published last year, August 2021. And in your spare time, you play rugby beach, whether in Hong Kong and in France. So you live part of the year in Hong Kong and part of the year in France?
Really part of the year in Hong Kong, part of the year in Canada. And I try to make it to France to see my team play as often as possible. But I sort of pop in, see them play, hopefully win, and then leave again. To be honest, I pick the games that I'm pretty sure we're going to win, so that the fans believe that when the chairman's here, we win. So
Great.
I build a sort of legend this way.
That's good. So here, just to finalize, you speak English, French, Mandarin, Spanish, and Portuguese. Is that right?
Yeah, Portuguese fluently.
Okay,
Portuguese is really like a natural language for me.
Okay, so let's get to the chase and discuss the global economy. But first things first. Who's going to win the World Cup? This is going to be your first call of the show.
The Rugby World Cup, France, every day of the week.
Soccer
World Cup. Well, I think if you go, through history, I don't know much about soccer, but it seems that every other time Latin America wins and every other time Europe wins.
Yeah.
So I think France won it last time, so it seems like Latin America would be about due. When you look at Latin America, you would have thought there would be 2 teams who could win it. But one of the 2 teams that ended up losing to Saudi Arabia. So if you pick the odds, I think you have to pick Brazil, I guess.
Great call. Do you agree, Bruno Lima? Great call.
Quick research.
Yeah, it was a great argument. Pretty nice little model that you just shared with us.
There we go.
And so you ended up with the call Brazil. That's okay.
Perfect.
Bruno, if you allow me, let me pose the first question. Let's start with China, Louis. As we speak, a lot of Chinese are taking the streets in protests against the zero COVID policy. And so in your view, how things should evolve from here? Do these protests, they help to hasten the opening process and the reopening of China? Or do they helps to, puzzle it a little further of this process? How are you going to see these evolving from now and the global impacts of it?
Sorry, just to compliment, and how disruptive is this episode,
Politically speaking?
history speaking,
So I could talk an hour just on all this because I think this is fascinating, because this is the first time really since 1989 that we have demonstrations all across China. Now, we actually have demonstrations very often in China. They're not really covered in the media, in the global media, because they're linked to local issues, maybe polluted water or corrupt officials or something. But these demonstrations are unique in that, A, they're in many different cities at the same time, B, because it's linked to a national policy, i.e. zero COVID. And what's also quite interesting is the people who are demonstrating. Usually people who are demonstrating tend to be amongst the poorest people. This time around, when you look at the pictures in Shanghai and Beijing and Wuhan, wherever else, it's actually middle class, upper middle class people. Now, historically, actually, the Chinese leadership tends to give in pretty quickly to protests. This is something that's not perceived in the Western world. In the Western world, we have this vision of, they send in the tanks, they're going to shoot down people, because that's what happened in '89. But you look at the past 30 years, each time there's demonstrations, the typical response of the Chinese Communist Party is to blame middle management. So you fire the local mayor, you fire the local party official, or you just move them to another town, and you give in. You give basically 90% of what people want. Now, what's interesting is China was already starting to move away from zero COVID. Hong Kong, where I live, they basically moved pretty much all the way from zero COVID. China was already reducing the amount of quarantine. And frankly, the Chinese market bottomed a month ago. It's outperformed the world MSCI by 11% in the past month on the back of hopes of zero COVID leaving. So for me, what's happening now is this is going to accelerate it massively. And you're already seeing the shift in the media. Yesterday, there was a big editorial in the Beijing Times, which is, obviously all the press is controlled by the government, right? There was a big article in the Beijing Times that basically declared victory against COVID. They said, well, you know what? Two and a half years ago, COVID was very deadly. So we protected you, but COVID's not deadly anymore. The new variants, they're more contagious, less deadly, so we can get on with it. That was the editorial in the Beijing Times. So that is now the message being pushed out there, which basically justifies reopening. And now, for me, the big questions to your question, what are the consequences? If we remember the reopening in the US, the reopening in Europe, reopening everywhere, Australia, Brazil, you saw typically two things. One thing was massive pent-up demand, right? When people had sat at home, the first thing they did is, okay, let's get in the car, let's go visit grandma, let's take a holiday to Paris, let's buy a new car. Like, there was always pent-up demand. Now, this was after typically 2 or 3 months. In China, it's been 3 years. So imagine 3 years of pent-up demand. Yeah. 3 years of nobody buying a car.
Pent-up Chinese demand.
A pent-up Chinese demand. Yeah, if your listeners are thinking of visiting Paris or Venice, they want to go right now. In 3 months, 6 months, it'll be them and their favorite 50 million Chinese tourists. So, you got to do it quick. So that's the first point, the pent-up demand question. But there's a second sort of probably more nefarious problem. If you remember, do you remember in the US, the summer they reopened, you had, it was the summer of canceled flights, right? Because pilots, stewardesses would get sick, call in sick, and you ran out of pilots. You ran out of guys working in lumber mills. So I have a house in Canada. You couldn't get lumber in Canada. That's like not getting sand in the desert. You couldn't because workers were missing everywhere for 2-3 months. People would call in sick, and people realized, hold on, if I need 100 workers for my assembly line, then I need to hire 120 because at any one time I can have 10, 15, 20 of them calling in sick for COVID. This is, for me, the big question. As China reopens, as COVID runs through the population, which is happening right now, how many people are going to be calling in sick over the next 2 or 3 months? And, can factories operate? So I think the market is getting this right, because if you look at the past few weeks, what you've seen is the hotel chains in China rallying, the Macau casinos rallying, the airlines rallying, all these things going up. But at the same time, if you're Apple, if you're Walmart, if you're Amazon, you're gonna have another supply shock. You're gonna have another 2-3 months where your factories aren't going to be able to work.
Interesting.
And so, in terms of what does that mean for the global world? Well, on the one hand, we're going to have a demand shock. All of a sudden, Chinese demand picking up. So right now, China's consuming 1.5 million barrels less of oil than it otherwise would. And as China reopens, boom, demand for oil, demand for airplanes, demand for LVMH handbags,
Luxury
for
goods.
Paris holidays, for Audi automobiles. It all goes back up. And at the same time, the iPhone factory shuts down. And the auto parts manufacturer, if you're making a car, if you don't have a gearbox, you have a very expensive paperweight. And if your gearbox comes from China, then you're out of luck for the next few months. So it's going to be a fascinating few months coming up.
Interesting. Yeah.
And so the summary, bottom line is you're bullish with the process.
I'm extremely bullish. Look, all the economic data around the world is looking bad, right? You've got OECD leading indicators rolling over, all the signs that the U.S. is heading into recession, whether if you look at your yield curves, your ISM surveys. But there's something we've never had before, is the second biggest economy in the world shut down for 3 years. Now, in the US and Europe, when people were shut down, you also had 100, 150 basis point drop in interest rates. And when it reopened, people said, oh, for the same monthly payment as I pay on my Hyundai car, I can now buy a BMW. So thank you very much. I'm going to do that. For the same monthly payment, I can get an apartment that's 50% bigger. Now it's the reverse of the coin in the Western world, right? Mortgage rates are up 200, 300, 400 basis points everywhere you look, except one place, China. Chinese mortgage rates, Chinese auto loans are 150 basis points below where they were a year ago. And now we reopen. So are we going to see the same thing as you reopen? Is the Chinese consumer going to say, oh, I can have for the same monthly mortgage payment, I can have this 50% bigger apartment. Yeah, I'm going to do that. I can drive a nicer car. Yeah, I'm going to do that. So, this is very hard to model because we've never seen this before.
Yeah.
But here's what I know. I think the amount of pent-up demand in China is tremendous. I think as it reopens, people will cash in that lower interest rate by upgrading apartments, upgrading cars, etc. And what I also know is that each time Chinese growth does well, emerging markets do well. Because most emerging markets are now so plugged into the Chinese economy. This is true of Brazil, but it's true of Indonesia, and it's true of Russia, and it's true of Saudi Arabia. It's true of so many places. They're plugged into this Chinese demand. As Chinese demand comes back super strong, it's going to be great for emerging markets. And what's good for emerging markets is also usually very good for Japan. It's very good for Europe, both of which today have very undervalued currencies. So what's interesting to me is everybody's running around saying the U.S. is the cleanest dirty shirt. You have to be invested in the U.S., etc. To me, it isn't at all. And the markets are already telling you it's not. And I'm sorry to rabble on, but I think it was Bruce Kovner, the founder of Caxton, who said, where I've made the most money in my career is when everybody in the market tells you one thing, i.e. the U.S. is the cleanest dirty shirt, and the market is already pointing another way. Today, everybody tells you the U.S. is the cleanest dirty shirt, and emerging markets are already outperforming big time. Now, imagine if I'd come here a year ago and I had told you guys, you know what? DXY, the US dollar is going to go up 20%. Fed's going to be much more hawkish than expected. Oh, by the way, buy a bunch of Brazilian bonds, buy a bunch of Brazilian equities, buy a bunch of Indonesian bonds, Indonesian equities, India. You'd have said, Louis, you're an imbecile. You'd have said, Louis, you've been doing emerging markets for 25 years, and don't you know that in a Fed tightening cycle, you sell emerging markets, you don't buy them. But imagine this. Amidst a Fed tightening cycle and a China lockdown that lasted much longer than anybody expected, emerging markets managed to outperform. So what happens now that if the Fed at some point stops tightening and at the same time China reopens, the two things that independently would help boost emerging markets are it's going to be super for emerging markets. It's going to be
value story.
They're both great value stories.
It's a re-rating process.
Yeah.
It's a massive re-rating process. And here's the interesting thing is it's only just started. Nobody's involved because everybody's like, oh, the U.S. is the cleanest dirty shirt. U.S. is where I need to
Everyone
be.
is underallocated right now.
Yeah.
Just sorry, but I mean, quick question here. But in your opinion, because of the this whole process, the political process in China and all the noise that has, the financial community, how do you understand regarding the following phrase? China, how investable is China nowadays for how much of the financial community, because my question is, if these guys if they can't invest in China anymore, or they don't want to, probably the flow for another emerging market, ideas.
Like Brazil, just for instance.
Yeah, can be huge. How do you,
Yeah, this is a following up question that I was already thinking as you were speaking, because is China investable or not? Because among the emerging markets allocation, you can get this bullish scenario and even more bullish like for rest of emerging markets apart from China, because is China investable or not? Because different things are starting to happen. I don't know if you agree. So this is why I would like to have your read on this. I mean, the third mandate for Xi Jinping, I don't know if that was, regular expected. I don't know how to read through it. And state intervention becoming loud and clear for everyone to see. Crackdown tech companies, crackdown real estate, education, gaming, you name it. So is China investable right now or not?
So we've moved, I think, from a world. I think we live in a very intolerant world. It's either black or white, 0 or 100. So in my career, 12 years ago, it was 0 interest rates. That was the big thing. It had to be 0 interest rates. Then we moved to, and that was, turns out we now know was a disaster. Then we moved to 0 carbon, right? And you can invest in carbon, and that's turned out to be a disaster. Then we moved to 0 COVID, and that's turned out to be a disaster. The new zero is zero China. It's that's the zero of the day. You have to be zero China for all the reasons you just highlighted. Now, I think we'll turn around in a few years and say, well, hold on. Does it make sense to be zero, the second biggest economy in the world, and the second biggest amount of growth? Because when you look at the next year and a half, most of the growth is going to come from China. Now, to your point, is China investable or not? There's no doubt that today the rhetoric is very much, when you read the media, you pick up the Wall Street Journal, etc. It is extremely anti-China. Does that tell you where you're going or where you've been? Where you've been, China's been a horrible equity market for the past 10 years, and it's been the world's best performing bond market for the past 10 years, something that nobody acknowledges because most people completely missed that bond bull market. Now, staying on the equities, there are a lot of reasons, as you highlight, the crackdowns, the slowing growth, lots and lots of reasons. But then the question becomes, zero for whom?
Yep.
Now, if you're a U.S. pension fund today, yes, maybe you can't invest in China. But is the marginal buyer of risk assets in the next 10 years going to be a U.S. pension fund? Most of these Western pension funds in the U.S., in Europe, etc., are becoming net payers. As their societies age, they start to pay out more money than they take in. I think the marginal buyer of risk assets over the next 10 years is the Abu Dhabi Investment Authority, the Kuwait Investment Fund, the Chinese insurance companies. Here's something that nobody talks about.
Sovereign guys.
China, sovereign wealth funds, but here's something nobody talks about. China, a week ago, started a new, there's very little pension fund industry in China, but what there is has always been basically defined benefits with very limited benefits. But it was basically, you contributed to the pension and the money you put in immediately went out to pay for the older guys who were already retired. This changed. Last Monday, they basically started the equivalent of 401ks or IRAs or Australian supers or Chilean pension funds, where people now can put in 1,000 renminbi a month into a dedicated account that has their name on it, and it's tax-free, and it accumulates over time. So China just did this on Monday, not yesterday, a week ago. How many articles did you see on this in the Wall Street Journal?
None.
When you see the weight now, sort of 15 years later, of the Chilean pension funds on the market, of the superannuation fund, and you do this time 1.3 billion people, this is going to be a massive weight. Now, for these guys, the only thing they can invest in is China. For now, over time, they'll be able to buy U.S. equities, etc. But I think the idea that no savings are going to go into China is the story of the past 10 years. It's not the story of the next 10.
Massive inflow.
The way you put it, should it be read as a threat to the U.S. dollar? I think what you just mentioned, some kind of reorganization or deglobalization, as you choose it, for financial flows.
Yeah, look, that's a great way to put it. Look, I think most, when you talk about deglobalization, which is undeniably the theme of the day, and it's actually, I wrote 2 books about it, one in 2019, another in 21. Most people, when they think of deglobalization, to your point, they think of the Apple supply chain or the Nike supply chain, when really perhaps the most important deglobalization is actually the deglobalization of financial flows. The fact that U.S. savings will now stay in the U.S. and European savings will stay in Europe and Chinese savings stay in China and Russian savings obviously stay in Russia. That people don't feel as comfortable putting capital abroad. Now, the reality is, if you're a country running massive twin deficits, current account deficits, and budget deficits, you need foreign money to fund this. If you think of the UK as a prime example, the UK for years has been running big current account deficits, big twin deficits, and the way they square that circle is they sell assets to foreigners, right? They sell expensive London real estate to Middle Eastern investors, to Russian investors, to Chinese investors. And now this year, the UK turns around and says, you know what? These houses that you thought were yours, because we don't like your country anymore, i.e. Russia, we're going to take them. And that football club you thought was yours, we're going to take it. And that yacht and that private jet, et cetera. And we're going to do that without any court orders, without any debate in parliament, from one day to the next, we're going to tear apart 500 years of property rights, and we're just going to take your stuff because we don't like your leader. Now, if you're Chinese, if you're Saudi, you see this and you think, shit, excuse my French.
No problem. You're in the club. Yeah.
Excuse my French, but next time it could be me. So, long-winded answer to your question. When you look, you say, does that threaten the US dollar? What's the biggest comparative advantage of the US? I think the biggest comparative advantage is the rule of law. The fact that when you own an asset in the US, you own it. You own that asset. And therefore, there's a certain security always in putting, much more so than, say, in China. And especially, but now,
you believe in the risk-free assumption.
Exactly. This year, let's not beat around the bush. We've changed the rules. And we've said that asset is yours depending on where you come from. You know, it used to be that whether you're brown, black, yellow, white, Muslim, Christian, Jewish, Hindu, if you go in front of a court of law in the US, it's equal for everybody, right? And now we've added a little asterisk that said, except if you're Russian. If you're Russian, we can take your shit. Yeah. We can take all your stuff. Yeah. No questions asked. And if you're Chinese, you look at this and you say, okay, that's not safe for me anymore because tomorrow it could be me. So long-winded answer to your question, but I don't think it's China threatening the US dollar reserve rule. I think the US is doing it to itself. Mm-hmm. I think they've, with the seizure of property, we've undermined we're basically cutting the branch, and I say we, the Western world, we are cutting the branch on which we are sitting. Our number one comparative advantage in the Western world is the sanctity of law and the sanctity of property rights, and we've just shot a huge bullet through it this year. Yep. And we've done it because we don't like Russia. And there's lots of reasons to not like Russia. I'm not defending Russia. But again, actions have consequences.
Yeah, you changed the game.
You changed the game. And by the way, China had nothing to do with this. Yeah. This was the Western world. We did this to ourselves.
I have still quick following up questions with these remarks. Number one will be, it's just brilliant the way you break down the way you break down deglobalization from you have the deglobalization, the supply chain, and deglobalization in the financial flows. Could you pick any kind of who could be the winners or the losers of this process? Maybe both process combined, or the deglobalization from supply side. You could have these and these winners and those losers in financial flows. You can have. Is it possible? Do you have like some?
Yeah, I think the big winner, to be honest, is broader emerging markets. What's been interesting in this Russia story is how emerging markets, most of them, Brazil, Mexico, Saudi Arabia, India, have all tried to stay neutral. Right, in this whole Russia-Ukraine war. Now, arguably, Russia broke international law. Right, it invaded a country, but basically, most of the emerging markets countries were like, this is not our problem, not our problem, and Brazil included. Yeah. Now, again, imagine you're a rich Chinese guy, and China still has a current account surplus with the U.S. of $40 billion a month. So you keep getting these dollars that you used to recycle in Vancouver property, in Sydney property, in New York City property. And I think, okay, I can't do that anymore. Where do you put that money? There's not a lot of places that are sort of big financial centers and that are neutral at the same time. I think there's really two or three. There's Singapore, there's Dubai, there's Mauritius. And these are this big. Yeah. They're like minuscule. Now, we know the Chinese, just to stick with them, love buying property. I tend to think that Singaporean property is going to be the biggest bubble we'll get to see in our lifetime. There's going to be as soon as China reopens, Singapore. They're going to take that money, go to Singapore, because culturally it's what's easiest for them. Yeah, people speak Chinese there. There's Chinese food. There's a direct flight at the same time zone. You're going to have so much Chinese money going to Singapore. And again, Singapore is about the same size as your studio. Yeah, it's give or take. It's give or take. It's like rounding error. So it's going to be a lot of money going into a very, very small place. It's going to be like Bitcoin times 10. and to some extent the same is true in Dubai. Although Dubai is better at adding capacity, so I think you want to own construction in Dubai and land in Singapore.
So maybe natural resources, property in I don't know, in Southeast Asia, something like that.
Yes.
Could be like the next big themes.
Yeah. They'll buy property in Phuket. They'll buy property in Bali. It's much more so than they'll go buy property in Saint-Tropez.
But at the same time, this whole story actually probably, I don't know, your opinion, that's my, regarding the percentage of defense, spending around the world, globally speaking, it has been increasing.
Yep.
Because of that. But I mean, when you forward looking, what's your, what's your framework to understand this?
So I think, we've had a few conflicts in the past. Obviously, the Russia-Ukraine war is the one we all look at. And Azerbaijan, Armenia is another one that happened recently. And then, you've had a conflict as well in Ethiopia. The big lesson of the past few years is that rather than buy, F-35Cs for $350 million and a pilot training that costs you $2 million, you buy drones that cost $150,000, $250,000, and your drone that costs you $150,000 can now easily destroy a plane that costs $350 million.
Yes.
So what's the point of a $350 million plane? So, for all the talk about how this uncertain world should lead to more defense spending, the reality is the technological breakthroughs we've had in military spending. We've seen technological breakthroughs everywhere, right?
Yeah.
I mean, all this equipment we have here, these very nice microphones, these cameras everywhere, these screens, 20 years ago, probably you wouldn't have been able to afford this.
Yeah.
It would have been so expensive.
Yeah.
And now it's a rounding error. Why wouldn't it be the same for the military? And the reality it is. The big lesson of the Ukraine war is that everything is now fought with drones. There's no point in having a tank that gets taken out by a drone. There's no point in having warplanes. There's no point in having anti-gun batteries. All this is taken out by drones. All the talk about in the past 6 months has been the Turkish drones and the Iranian drones because they're the cheapest producers, because you can buy them and basically throw them. You can swarm the enemy with drones. So all this to say, if you want to look at the one bullish development of this Ukraine war, and I know we shouldn't talk about it this way because it's human tragedy, etc. But the one positive development of this Ukraine war is everybody should look at the military budget and say, I don't need to have an army with 1 million guys.
Yeah.
And with expensive, pilots that cost $2 million to train. I just buy a bunch of drones and have 17-year-olds in a hangar, fly those drones, and that's that. That's my army now.
So oil could be the new hedge.
I think oil is the new hedge.
For long term.
For long term, look,
This is the hedges. Let me jump in with the oil topic.
We have to talk about Brazil, don't forget.
Yeah, sure. we will get there. But here's Brazil as well, because not oil, but the whole commodity complex. When the question that I was going to pose, is still a follow-up with the very first question of Chinese reopening. With all this pent-up Chinese demand coming up to the market, the impacts on oil, the impacts on commodities, and here's the thing, the impacts on the global inflation and rates outlook.
Okay, so China right now is probably consuming 1.5 million barrels a day fewer than it otherwise would, right? So when it reopens, if we can assume that people say, hey, get in the car, we're going to go visit grandma, get in the plane, we're off to Paris, then so you get this big increase in oil demand. Now, at the same time, we know that starting at the beginning of 2023, the U.S. has been releasing 800,000 barrels per day from the Strategic Petroleum Reserve. So they stopped doing that. So now all of a sudden, you have a 2 million, 2.5 million swing in the global supply demand balance. And so where's that 2.5 million going to come from? OPEC can probably add at a stretch up to 1 million. So that leaves you with 1 million, 1.5 million that needs to come from somewhere. Maybe Brazil, Colombia can add in another 300,000, 400,000 barrels, but you're still scratching, you're struggling. You're missing at least 500,000 barrels, however you cut it. And that's assuming that Russian production doesn't collapse. If you think, with the lack of Western technology, the lack of pieces for their oil industry, on the other side of this winter, because of the wear and tear that happens through the Russian winter, Russian production starts to collapse, then we're completely stuffed. Then oil prices, go to $150, $200 really, really quickly. Now you could say, the one caveat to this is you could have some replacement. We use coal here, natural gas there. But no, I think, look, the energy situation is extremely tight around the world, which reflects a lack of investment for 10 years, right? Mm-hmm. So, no, look, I think energy prices move noticeably higher in 2023. So to your question, what's the impact on the global inflation? You could have in the first 6 months of 2023, imagine this, much higher commodity prices as Chinese demand picks up on the one hand, or really doesn't pick up, but actually soars. Mm-hmm. And on the other, supply chain dislocations in China as everybody calls in sick. As you don't, as like the Apple doesn't, the workers can't go to the factory to produce for Apple, to produce for Amazon, to produce for Walmart and whoever else. So you get, at least in the short term, a sort of a double hit. And by the way, I think the market's gotten that right. If you look at, it's been, to me, pretty obvious that China was starting to reopen about a month ago. Basically, once everything dropped in Hong Kong, you thought, okay, they're starting in Hong Kong, making sure it's okay. And if that mm-hmm. works, they're going to bring it onto the mainland. Since then, Macau casinos have gone up, hotels have gone up, restaurants have gone up, and Apple's gone down. Because that's the world that makes sense.
Supply shock feelings.
Yeah. It's basically the last supply shock of the COVID wave. China reopening will be the last supply shock of the COVID wave. And then once that's done, then we're back to a normal world. Because we are not back in a normal world. We have the second largest economy that's still locked down. But in 6 months' time, 9 months' time, we'll be on the other side of that, and then we'll be back to normal.
A lot of implications because the Fed pivot, correct?
Yeah, pivot. That's going to be my following question. I mean, that's not such of a good news for inflation outlook and especially the Federal Reserve, is it?
No.
Yeah, no, like smiling. Absolutely happy, no.
No.
Hello.
No. It's not. But here, I'd say, look, every 10 years you have a bubble. In the 1970s, it was energy. In the 1980s, it was Japan. In the 1990s, it was global telecoms and internet. In the 2000, it was the view that China was going to take over the world. And the 2010s, it was US tech / software eats the world. And that bubble is now imploded. That this view that, this software eats the world, this is the only place you can be invested, you have to be in US tech. Now, most people, as the bubble implodes, most people still sit around thinking, oh, when do I buy back my Facebook? When do I buy back Google? When do I buy back Amazon? Ooh, I know. I'm going to wait for the Fed to pivot, and then I'm going to buy Amazon. But look, that makes as much sense as sitting around in 1992 in Tokyo thinking, oh, when is the BOJ going to cut? When is the BOJ going to cut? I need to, when the BOJ cuts, I'm going to go back and buy Fuji Bank because, it's down 50% and Fuji Bank is the place to be because Japan's going to take over the world. Or for that matter, it makes as much sense as being in 2013, 14, thinking, ooh, when do I buy back Petrobras? Forget it. Like, that was the previous bubble. That ship has sailed. Now, you want to buy back Petrobras now, by the way.
Yeah.
But back in 2013, sitting around wondering, when do I buy back Petrobras was not the right trade. You needed to change the software in your head and say, okay, forget that. The new bubble is Google, it's Amazon, it's Facebook. And bear markets are there for a reason. Bear markets are there to change the leadership from one group of stock to the next. Now, we've had the bear market. We are in the middle of it. If you're sitting around thinking, when do I pivot to buy back Google? You're asking yourself the wrong question. The question is, we're in a bear market. That bubble's imploded. Where is the next bull market? And the answer is always, it's whatever leads the recovery in the bear market. It's whatever starts to outperform. And when you look at today, where is the outperformance coming from? The outperformance is coming from emerging markets. It's coming from Brazil. It's coming from Indonesia. It's coming from India. And again, this outperformance is occurring against a backdrop that should have been extremely penalizing for emerging markets. You had China locked down and tighter Fed. And in the coming year, the Fed is going to have to be less tight than it's been. But more importantly, you're going to get China reopening. And emerging markets are going to fly. They're going to fly. And the question isn't, when do I buy back Google? The question is, what should I be buying in emerging markets? Which one? Which companies? But nobody's asking that question.
Yeah.
And that's where the opportunity set is.
Market is misreading the most important pivot, which is not the Powell pivot, is the she
Exactly.
pivot, right?
Exactly.
Yeah, correct.
Interesting.
And now coming to Brazil.
Yeah, starting to address the end of our conversation, Louis, and then we'll save your answers on Brazilian assets. A lot of spoilers, by the way, but we'll save your position on Brazil for the last minute. Just for you to start to warm up, we have this question here, which we call, in English, will be for you to share an epic fail with us, like that forecast that you have really high conviction, or your call, or a scenario.
If it's not China, I don't know what it is.
No, but you get it wrong. You get it really massively wrong, and you have to change it. But you took a lesson with it, and you improve as an analyst.
Sorry, you're talking about the failures.
Yeah,
sorry, I thought it was
epic fail.
Yeah, sorry.
It's the free translation for deu ruim.
Yeah.
In Portuguese, it's deu ruim. Let's do an epic fail.
So many.
Yeah.
So many to pick from. But
Okay.
here's one that still sort of gives me cold sweats.
Okay.
So back in 2009, 10, it became pretty obvious to me that Europe was cruising for a bruising. That basically the euro might implode. That there was Europe was. So with a friend of mine called Mark Hart, we set up something we called the European Divergence Fund. And our view was very simple. It was, we're looking at Europe. Europe was going to implode. Greece was borrowing at the same rate as Germany, and Italy was borrowing at the same rate as Germany, et cetera, and that couldn't last. And so we pitched, our clients raised a bunch of money to do two things. We bought, on the one hand, a ton of CDS credit default swaps on Greece, on Italy, et cetera. And then on the other hand, that was half the capital. And half the capital, our view was the euro was at 125, 120, 125. Our view was the euro had to plummet, because Europe was going to implode and the currency was going to collapse. So we made a lot of money on the CDSs.
Yeah.
The euro went from 120 to 150.
Jesus.
I don't know if you don't remember this, but in 2011, 2012, the euro kept going from 120 to 130, 135, and we were shorting the whole way.
Jesus.
And making money there, losing it here. Making money here, losing it there. And we were getting our faces ripped off on this rising euro, even though by 2011, it was obvious that Europe was imploding. The spreads were opening. It's obvious that Greece was going bust. And we're getting our ass kicked on the currency. I'm like, how the hell is this possible? And at the time, I talked about it with my dad, and he'd managed a big macro fund in the 90s. And he said, oh, you should have been in Japan in the 90s, because by 1990, 91, it was obvious the Japanese bubble had burst. So it's like, okay, BOJ is going to have to slash rates. So I'm going to short the Nikkei, and I'm going to short the yen. Now, the Nikkei halved. The yen went from 160 to 85, which means it rose. And so you made again same story. Made money on the one side and got ripped off on the other. And so the lesson I drew is that currencies are tricky.
Yeah, number one.
Currencies are very tricky. And the second lesson I drew is when a country actually hits the wall, you can have a period of 2-3 years of currency strength where linked to basically capital repatriation. Because what happened in Europe, what happened in Japan is the insurance companies brought back money. The banks brought back money. The pension funds brought back money as they were bleeding just to patch up the holes, selling foreign assets, bringing money back. This is what happened in Europe. This is what happened in Japan. And here's the question. is this what's happening in the U.S. today?
Yeah, I was wondering.
As you look at a U.S. dollar that's just gone up sort of 20%
Interesting.
in a straight line, and everybody runs around saying, "Oh, it's because the U.S. is the cleanest dirty shirt." Meanwhile, what you know is that every pension fund in the U.S. came into this crisis underfunded, and definitely nobody in their model had a 20% hit on equities and a 20% hit on bonds at the same time. What you also know is that the U.S. economy is probably one of the most sensitive to the capital markets. And you've just had $15 trillion of capital destruction in the U.S. between the equity and the bond markets. You've had, which you've never had before. In 2008, it was $8 trillion of capital destruction because what you lost on equities, you made up on bonds. But here, all these pension funds, their book has just been blown up. Now, on paper, I think it still looks okay because of private equity, because of private debt, because of real estate. But you know that's just mark to make believe. The mark to market still have to come in private equity and in private debt and in real estate. And so could it be that part of the rise in the US dollar is capital repatriation to plug the holes? As you look at this sort of parabolic rise, it's not natural for the world's biggest currencies, whether the yen, the euro, etc., to have these big 2.5, 3 standard deviation moves. So anyway, hope that answers your
but
question.
great
interesting.
insight. Yeah.
Really interesting, really good insight from this epic fail. We keep learning, and the greatest thing to learn from the others. So we bring all the guests here to share their their tough times, their epic fails, and how they learn and how they improve their.
I think it's what Lord Keynes used to say, that smart people learn from their mistakes. Very smart people learn from other people's mistakes.
Yeah,
Great.
And so okay, couple of last minute.
Yeah,
One important question that the club members always demand. What's your favorite TV show or streaming show that you would like to share with us, so the club members have to go on and watch it?
Oh, so I'm not
in their spare time.
Okay, I'm not a huge TV guy, to be honest. So Band of Brothers I thought was exceptional.
Great.
on World War II.
Yes.
I really couldn't put that one down. There's a French TV series for your listeners who do speak French called Engrenage, which I also really sort of has been one of my guilty pleasures over the years.
Okay.
And
How is the TV series called, Bruno Lima?
what?
The TV series, the French one.
Pardon, ma France.
Engrenage.
Engrenage. Sorry.
So, Louis, back to where we started. There is a growing consensus here because, on the one hand, locals are very worried on the fiscal outlook of Brazil and this transition government, new government in place as of 2023. But on the other hand, the foreigners, international investors, they're looking to have glass full in terms of, okay, in this global scenario, especially among the emerging markets, Brazil is standing out as the cleanest dirty shirt. Would you agree with that?
Like, absolutely. And I would say, in life, and especially in markets, it's always better to be lucky than good, right? Yeah. And I would say that I think the luckiest man alive is probably Lula. Yeah. Because he came in just at the right time in the 2000s to ride the massive commodity bull market, etc. And, returns on equities, on bonds during the Lula years were exceptional.
Yeah.
Investors in Brazil during the Lula years. If you remember the first time he got elected, I remember people saying, "Oh, he's the new Chavez and it's going to be horrible." And it turned out to be the 10 best years or 8 best years in Brazilian history in terms of compounded returns on both bonds and equities. And there's a good chance he pulls it off again.
Yeah.
That he comes in right at the right time. As China reopens, as commodities do well, budget surplus turns out to be better. Now, I think for all the people being fearful of what does Lula do, etc. I think he is constrained by the fact that it's not like he controls the Congress like fully. It's not like he controls the region. So I think his ability to be a Hugo Chavez is extremely, extremely limited. So I think that perhaps the political risk is overblown. He wasn't a Hugo Chavez when he was young. I don't think he'll be a Hugo Chavez when he's old. I think that political risk is overblown. And yes, I think fundamentally there's a lot to like in Brazil. I think there's a lot to like in many emerging markets. I'm very optimistic on on a number of them. I think Colombia and Chile also look great, and their currencies are much cheaper than the real. And on this, I have a special fondness for undervalued markets and undervalued currencies. To me, that's you got two massive pillars of support. And you can find that in a lot of places, both in emerging markets and frankly in some of the developed markets. I would say that, Japan is extremely undervalued in an extremely undervalued currency. Same with South Korea. Here I'm going to show a little homegrown bias, but perhaps even France is, undervalued. And so, the only place that's overvalued in an overvalued currency is the US. That's it. Now, will Brazil do better than other emerging markets? Who knows? It'll depend partly on politics, etc. Will investors do well in Brazil? Yeah. In fact, I'll put my hat on.
There you go.
I'll put my
there
hat on.
you go, Louis.
I guess I'll look at the camera.
Yeah.
And,
that's a really nice clothes you have there.
And I'm pretty confident that Brazil will do well.
Okay, great.
Finale.
What a 50th episode. CLUBE and all the club members deserve this 50th episode, this very special 50th episode. Louis, thank you very much.
My pleasure.
Thank you very much. We are really happy to be Gavekal subscribers and to have this Gavekal partnership here at Exame. And great for the honor to squeeze us in your busy agenda. Hope to see you again soon.
Absolutely. Thanks a lot for having me, guys. Really enjoyed this.
Thank you, Bruno
Thank
Lima.
you, guys. Amazing
Vejo
episode.
todos vocês no próximo episódio. Um grande abraço.